to the Trading Room Live. It is the 7th of March 2016, 2 p.m. in Central Europe. My name is David Hickson, and in this webinar I hope to shed some light on using Hurst cycles as a way of analyzing and then making trading decisions in financial markets. Before we really get started, I need to show you these disclaimers. They are important, and so please make sure that you have read and understood them before we get stuck into the webinar. I thought that in today's webinar I would zoom in a little bit. In my previous webinar 2 weeks ago, I took a big step back, which is not something I do very often. I must say, personally, as a trader, I find it very refreshing to take a big step back and look at what's happening in the bigger, longer term picture. So we spoke about that at length last week. If you haven't seen it, then please go to our YouTube channel, Sentient Trader YouTube channel, and take a look at the recordings there. I hope you'll find it interesting. It presents a much sort of longer term perspective about what is happening in the markets that we trade. In particular, of course, I focused on the stock markets, and in particular the American stock markets. All stock markets to move with a great deal in common because of Hurst's principle of commonality. And so if you understand what is happening in the US markets and the American markets, then you have a good head start at what's happening in other stock markets around the world. Now, Sid Norris, who has been a guest on a previous webinar and who is primarily an Elliott Wave analyst, he's a very rare Elliott Wave analyst in that he combines Elliott Wave analysis with Hurst cycles analysis. It's an extremely powerful combination, and Sid joined me on a webinar towards the end of last year, and we discussed his take on the markets and, of course, how one can combine Hurst cycles with Elliott Wave analysis. Sid does a weekly webinar on a Sunday, I believe, and he discusses his analysis of the market. And he shared with me this weekend an analysis he's been looking at in Sentient Trader. And so I thought I would start the webinar. Oh, see, there is Sid. Hello, Sid. In fact, what I will do is, let's see if we can open your microphone. But let me just sort of provide the background to this chart that I'm showing you. Sid was kind enough to share this chart with me. And there we go, Sid. I think I have enabled your microphone. So if you see anything happening on your end, say hello. Sid shared this chart with me, and it's an analysis of the SPX, as you can see from the title. And the analysis starts in 1980, and the reason for that is because of the potential prominence of the 1982 trough. And as Sid mentioned that in Chris's book, that's Christopher Grafton's book, Mastering Hurst Cycles, he suggested that the 1982 trough was a trough of the Kondratiev cycle, often called the K-wave. Now, the Kondratiev cycle is usually a 54-year cycle. Of course, sometimes it runs short, sometimes it runs long. And Chris, in his book, suggested that the 1982 trough could be considered a trough of the Kondratiev cycle. And I see Gelov asking which book. It's a book called Mastering Hurst Cycles, written by Christopher Grafton. And in fact, as an aside, I'm hoping Christopher's going to be joining me on a webinar fairly soon. I've been speaking to him about doing that. And it's a great book, as David says, a really excellent book. It brings Hurst cycles. It sort of brings it up to today, so that we're not having to refer back to material written in the 1970s. Mastering Hurst Cycle Analysis. There we go. Thank you, Claudia. Mastering Hurst Cycle Analysis as opposed to Mastering Hurst Cycles. So in that book, Chris mentions that the 1982 trough could be considered to be a low of the Kondratiev cycle, the K wave. So Sid took that as a starting point and started exploring an analysis in Sentient Trader, and I have two charts to show you today. And this is the first one. I think I can hear Sid. Does that mean your microphone is working, Sid? Are you there?
I hope so.
Yes, fantastic. Thank you so much for agreeing to speak to us. Perhaps you would, I'm showing the first of your two charts. Perhaps you'd like to just say a little bit about this chart and the issue around the 2002 low and some things like that.
Sure. Well, I've been thinking for a while that the 2002 low was because it was the end of the first multi-year bear market going back 20 years, should receive a fairly large cycle designation. And
Right.
but if you use different starting points, I've got Dow Jones Industrial Average data going back to 1900, and I've tried a whole bunch of different starting points on the data, and the phasing comes up a little different sometimes, depending on where your starting point is. And my favorite starting point has been up till I found this was 1973, so that it would catch the dip into 1974, which I consider
Right.
to be the end of the last cycle degree, wave 4.
Right.
And then, but some through the years, some Elliotticians have marked the 1982 low as the end of a long sideways period that started in 1966. It just wasn't the low of that period, but it really was the final dip before the market really took off to the upside. And so I found it interesting when I got the book and read it that he was that if you go back to 1932, that 1982 is 50 years from that point. So Christopher thought that the K wave ended about 4 years short of normal. And that's within acceptable parameter. But if you figured that it ended in 1974, that's just too much variation from the 54 year cycle, and so it made sense to start it in 1982. And when you do the analysis, this is just a basic nominal model, no repinning. It does place a 18-year cycle trough in the 2002 position. And then moving forward from there, the next
in fact, let me draw over that semicircle for the 18 year.
Yeah, the next 18 year would be due in 2020. And
2020. Right.
That 2020 date has come up in a number of different analyses as a potential important bottoming date for something. But the problem I had with the analysis is the same one that keeps popping up over and over again, and that is that 2009 low. Sentient Trader wants to place the 9-year cycle trough there within that last 18-year cycle, and so that's early. That's pretty early inside of the 18-year cycle. And it creates a fairly large staggered nest by the time you get to the end of the 18-year cycle. So there's a difference of probably looks like at least 3 years between the projected end of the 18-year cycle and the projected end of the 9-year cycle. And then the other aspect of this chart, I put the fabulous composite line on there, and it followed price pretty well until about 2011, 2012 timeframe, and then you can see up there, I made a note in the upper right, yeah, that the composite line and price diverged.
Yes.
And the composite line was expecting a pretty significant dip down into 2013. We just didn't get it.
We just
And
didn't get
that's
it.
the
That's right.
problem I've been having with the analysis. If it considers 2009 low as a very large degree, in this case 9-year cycle low, is that we just never got that dip into 2013.
Yeah, yeah.
Not one
So
large
can I interrupt there and just
Yeah.
just expand a little bit on a few of the points that you've mentioned, particularly for those of us here who are new to Hearst cycles and working with Sentient Trader. First thing that Sid mentioned is that when you're performing an analysis with Sentient Trader, an important aspect of it is where you start your analysis, how much data you show the software in order that it can perform its analysis. And with different starting times, you can sometimes produce different analyses, although they will often have a lot in common. And so that's the importance of mentioning that Sid has started this analysis in 1980. By starting the analysis in 1980, it gives an increased prominence as far as the software is concerned to the 19 prof. And let me just quickly switch screens to my Sentient Trader chart that I've got open here. It is the S&P 500, basically the same instrument, from 1951 up to 1986. And you can see what Sid was saying. Here's the 1964 low, which I spoke about in our last webinar, and I spoke about how that was probably a trough of at least 18 years magnitude, so the really strong trough over there. The interesting thing about the charts that Sid is speaking about now is that he has forced the software to move that very big prominent trough from 1974 to 1982. So here is the 1982 trough. Now you can see, just using a default analysis, which is the analysis that I looked at last week, Sentient Trader places the 18-year cycle trough in 1974 because, of course, visually, that's the most prominent trough. Okay, but as Sid mentioned, there are many wave analysts who consider the 1982 trough, the later trough over here, as probably being the correct positioning for a major cycle low. Okay, instead of the 1974 trough, and I'm sure there are Elliott wave reasons for considering it, but that was the inspiration for taking a look at this possibility in Sentient Trader. And so let me just go back to the chart that we were looking at. Where are we? So here's the chart that the analysis that resulted as a result of asking the software to start its analysis in 1980. Of course, the first big trough that the software found in the data is in 1982, and so the software has positioned that very big trough, the 18-year cycle trough, in 1982. It then positions the next 18-year cycle trough in 2002, which makes sense and seems like an obvious position for that trough. But then the next 9-year cycle trough, the software has positioned here in 2009. That's the very important, prominent trough in 2009. And an interesting thing happens when you perform a Hearst cycles analysis. When you look at the charts, you can often see the cycles really clearly, and that's the obvious reason for that cycle trough to occur. As you begin exploring the subtleties of Hearst cycle analysis, you begin to realize that the obvious troughs in price are not necessarily the correct positions for those cycle troughs. and that sometimes a better analysis can be achieved by shifting the cycle trough a little bit. And this is where we're going with this discussion. I'm going to show you in a moment an analysis that resulted from SID shifting this cycle trough over. It's a process that we call pinning in Sentient Trader, because you pin a cycle trough to a different position. It's a fairly easy way of asking the software to position the cycle trough in a different. Just to sort of complete this part of the discussion, Sid mentioned how the price and the composite line diverge. Now, the composite line is I hope you can see this. It's the sort of orange line over here that is shadowing the more colorful red and green price line. And so we call that the composite line or the composite model line. And basically what the software does is it takes the results of the cycle analysis and it recomposes them. So it takes all the information about the cycle wavelengths and the amplitudes, and it puts them back together again. And it plots that line. So that line is, if you like, an idealized portrayal of the cycle model that the software has built as a result of performing its analysis. And of course, you don't expect the line to be perfect, because there are other influences to the price movements in financial markets over and above cycles. There's often some sort of random noise influence, and there's sort of much longer term trends and cycles and economic cycles and so on, which are influencing the price movements as well. But when you see a composite model line which follows price movement very closely, then it indicates that your cycle analysis is, if you like, including or considers a great deal of the influence that is moving the price. So it gives you an indication that it's a fairly good analysis. It points out the composite line follows price fairly accurately in terms of identifying not only when the price peaks and troughs occurred, but also to some extent their levels. Up until this period over here, where the composite line, I've now drawn over it, it hasn't really helped, but the composite line diverges fairly strongly from price. And we had the situation where in 2013, price just didn't come down into what should have been a 4.5-year cycle trough. It just a very effective 4.5-year cycle trough. I see a few questions or comments. Let me just quickly go to there before we move on to the next chart, which is the punchline, if you like, for this part of the discussion. David at Tradinghurst says it's worth looking at the longer term FLD peaks and troughs for more evidence. Yes, that's a great point. FLDs are very useful. I love working with FLDs, as you probably know, and looking at where the FLD peaks and troughs form, or where the peaks and troughs form in the FLD, provides additional very interesting evidence. We won't take a look at that now, but it's definitely something to do in the future. Piotr says, I don't know if I'm pronouncing that correctly, do you have enough data to show us a 54-year cycle FLD? No, Piotr, I don't. The data I have in the Sentient Trader that I'm running here on the desktop goes back to 1950. You might think that's enough data for a 54-year cycle, but the software doesn't actually go all the way up to considering a 54-year cycle. So I can't show you a 54-year cycle FLD, unfortunately, is the simple answer. It's an interesting thing to look at trying to achieve. I might try and see if I can do that before our next webinar. Najmuddin, does the composite... The DAO, yes, the DAO, absolutely. I would need to, of course, build a nominal model that includes a 54-year cycle in it in order to see a 54-year cycle FLD. So I'm not going to keep you all hanging on the line while I do that. But it's a very interesting idea. Najmuddin, does the composite model line include the effects of the principle of variation? I mean, if the period is varying, and then does it consider that? Yes, Najmuddin, it does. The composite model line is not a sort of a magical line. it's a very mathematical. What it does is the software, had an analysis, works out where all the troughs are and all the peaks if you perform a double analysis, and it measures wavelength. It's as simple as that. Okay, so it doesn't have to consider the effects of the principle of variation, because it is using the measured wavelengths of those cycles. It also then measures the amplitude of the cycles using the very simple approach that Hurst himself used, which was a method of moving average subtraction. Let's not dwell on that now, but the composite model line does include the real measured cycle wavelengths. Okay, I hope that sort of answers that question. Let's move on to the next then. And sort of move forward with this discussion. So here is the analysis Sentientron was performing by default. Sid then went along and pinned a trough, which is a fairly simple process, and he pinned the trough in 2011. And when I last had Sid on the line, we had a discussion about the magnitude of that trough in 2011. So here is the result of that analysis. Perhaps, Sid, you'd like to just a little bit about this chart as well.
Well, I've been looking at this 2011, this pin to 2011 for several years now, and it's a very prominent trough in some important items that have high correlation with stocks. The most important being, in my opinion, the USD JPY currency pair. That October, around October of 2011, was the end of a multi-decade 5-wave impulse to the downside in that pair, and so and the end of terminal pattern in Elliott wave. So it's very, very significant low. And ever since the 2011 low, stocks and that pair have been very highly correlated, and as many know, the USD-JPY pair moved very strongly up from the 2011 low all the way into recent highs in 2015, almost identical to U.S. stocks. And there's many others that are placing a very large degree trough in 2011. The DAX, the FTSE.
Yes.
And these are generally items that I would start the analysis at the Y2K high.
Right.
And so and then 2011 was also a very significant and major top in commodities, gold, and 2011 was also the low in U.S. stocks since Y2K when priced in gold. So I've felt pretty comfortable.
That's a very interesting point.
In going ahead and bumping that 9.5-year cycle marker from the 2009 low over to 2011, and you can see that it evens up the phasing beautifully. Have very and you no longer have a staggered nest. You have an expectation of the 9-year and the 4.5-year and the 18-year cycles all coming together into a trough somewhere in that 2022 time frame. And then of course the composite line in it doesn't diverge as it moves up into the 2015 high. It stays right with price all the way.
Yes. Okay, so a few really interesting points there. So Sid is saying that the 2011 trough, although it looks less significant on this chart of the SPX, was a very significant trough and peak in various different markets. Hurst's principle of commonality tells us that all markets move with a great deal in common, and the way in which we use that principle is that when we identify a trough or a peak in another market, then very often that trough or peak should be similarly rated, if you like. It should have a similar magnitude in the other markets that we look at. Something that we never really say, but should always be considered, is that this price of the SPX is effectively priced in US dollars. And so the chart we're looking at isn't purely the value of the SPX. It needs to be looked at as the value of the SPX in terms of US dollars, effectively. And if you take a look at the value of the SPX as valued in gold, so in other words, if you were trading between gold and the SPX instead of using your US dollars, then of course you get a different shaped chart, and the magnitude of the 2011 trough is that much greater. It's a much more prominent trough. David at Tradinghurst says he really likes this phasing, and I must say I do. I hope you can see these semicircles at the bottom. The new version of Matter of Interest produces much more prominent semicircles. You can adjust the width of those lines for exactly this reason, so that we can discuss them and all see them on the screen. But if you can see those semicircles, you will also be able to see that they are very regular. And I love a phasing analysis that has regular cycles like that, basically sort of even-heighted semicircles at the foot of the chart, because it shows that the cycles are running really sort of regularly. And an analysis that has these regular cycles always looks good to me. And so that's one indication that this is probably a really good analysis. Another possible indication is the composite model line, which, as Sid points out, isn't diverging in price. Of course, it does diverge a little bit because of the fact that the composite model line only considers the pure cycle information, the mathematics of the cycles, if you like. Doesn't consider any of the other aspects that are influencing price movements. Composite, as you can see, sticks much closer to price, which is probably another indication, although the composite model line is something that we're still exploring and understanding, but it is probably an indication that this is a very good analysis. In Hurst Cycles course, and I know many of you have read that course and studied that course, in Hurst Cycles course, he spends quite a lot of time discussing situations where important troughs shouldn't definitely be placed at the most obvious positions for those troughs, such as the 2009 trough, and how sometimes these troughs occur afterwards. So this is, in many ways, a sort of a really long-term textbook example of that aspect of performing a Hurst Cycles analysis. It's a very subtle and rather complex aspect of performing a Hurst Cycles analysis, something that I still have to work to understand. But this produces a really interesting analysis, and you can see the composite line tells us what we should expect as a result of this analysis, which is pretty much a bear market all the way into 2022. So there's your punchline. That is the result of this analysis, and this analysis looks really good to me, and so it's certainly something that we need to pay attention to and bear in mind the possibility that we're going to get that strong move down into 2022. Sid, before I turn off your microphone, perhaps you could just sort of bring this full circle and just for a moment mention what you think that big move down into 2022 would represent in Elliott wave terms. If you can do it sort of quickly like that. I'm not sure whether that's possible.
Yeah. Well, starting at the 2000 high, I think that was the end in the year 2000 of a 5 wave impulse in U.S. stocks up from the 1932 low. So the 1929 through 1932 crash of 90% in the Dow Jones Industrial Average created the 1932 low, which Grafton considers the obvious 54-year K-wave bottom, but also that's the end of 5 waves up. So I think it's still in a correction from 2000, and that first move down into 2002 is wave A, and then to move up to 2007 is wave B of a triangle, and we move down into 2009 is wave C of an expanding triangle, and the move up through 2015 is wave D of an expanding triangle. And in expanding triangle, the last time we saw an expanding triangle in stocks was theoretically from 1966 through 1974. Yeah, the 1966 high is right there. Yeah, so there's the A to the downside, the B up, C, D, and E, and C. That last wave E was a substantial crash from 73 to 74. It's only took 18 months for the stock market to drop in half. And so I'm expecting that we, in the middle of 2015, started into a wave E, and it's just getting kick-started, and it could be a fairly devastating move. Probably not as deep as the composite line is suggesting, but reaching a line extending from A and C. And so, in other words, it would, in an Elliott wave, it would have to end below the 2009 low.
Right. Okay. So below the 2009 low. Okay. Fantastic. That's fascinating. Thank you very much, Sid. Thank you so much for agreeing to today's webinar. Thank you. Let me just quickly mention a few things there before we move on. Let me just turn off that. There we go. Turn off that microphone. Okay. Sid has just explained how this might relate to one of the sort of Elliott wave analyses that considers this to be an expanding triangle. He mentioned that, of course, the composite line is moving all the way down to below 100. And in fact, last time I showed this composite model line on a webinar, I got some emails about Bloomberg wanting to know when the S&P 500 was going to zero. The composite model line, as I've mentioned, and I see another question about it there, so I'll get to that in a minute. The composite model line takes the information it has about the cycles, but of course it makes a few assumptions, and the first assumption that it does make is that cycles are going to be balanced. That assumption sort of underlies its approach to producing the composite model line. As you can see, it works fairly well, but when you're looking at big cycle moving into the future, what the composite model line is doing, I can tell you, is it's measuring the amplitude of the 18-year cycle, or in this case, probably the 36-year cycle, is measuring that amplitude, and it's saying, okay, that cycle has carried price all the way up to the peak over here. So therefore, the amplitude of that cycle is really pretty big, and it's going to carry price all the way down again. Okay, that of course is not necessarily true, but and in fact, it's almost certainly untrue. But if we were to make the assumption that price would not extend as far as the amplitude of the cycle indicates it should, then we would be making an assumption that would also be untrue. If we were to make the assumption, on the other hand, the cycle amplitude will increase and it will take price much further down than it has taken it up, then that would also be an untrue assumption. So the composite model line takes the neutral assumption that the amplitude of the cycle is going to continue as it has been measured. And so the composite model line will often exaggerate what is expected to happen in the future. But the important point is that the composite model line indicates fairly clearly what the analysis is telling us, which is that the market is going to go down until 2022. I often say when speaking about the composite model line, you should consider the shape that the line is making on your chart, and not look at specific levels. Those aren't targets generated by price crossing and FLD, for instance. They aren't valid targets at all. They simply give you an indication of in what direction the market is expected to move. So thanks once again, Sid. That's a really interesting an analysis, sort of an update on our last webinar's longer term picture. In a minute, I'm going to take a look at what this all means for the short term, and we're going to get to the main subject of today's webinar, which is what to expect over the next few weeks, because that's what I would really like to speak about. Let me quickly see what questions I've missed. There have been lots of questions and comments. I see one from Najmuddin, I think, that haven't answered that. He says if the composite model line is not following the price, then our periods may not be accurate. Yes, indeed, periods may not be accurate, Najmuddin. It's one of the aspects of Hurst cycles analysis, that because of the principle of variation, the cycle wavelengths do vary. They vary back and forth around an average wavelength, which has remained fairly constant for a fairly long time. Yes, it cannot be entirely accurate. The composite model line makes the assumption that the wavelengths will continue to beat at their current length, which is a flawed assumption to make at the outset, because we know that they will vary. But it's the same as for the assumption of amplitude. We can't assume that the wavelength is going to get longer or that the wavelength will get shorter, because both assumptions will probably turn out. So the assumption that the wavelengths are going to continue in their current at their current state, their current wavelength, is the safest assumption to make. I call it, or I have called it, the cycle analyst's paradox, because the paradox is that you have to use some number in order to project into the future, but you know that whichever number you use is inherently a flawed assumption because of the principle of variation. It's going to turn out to be wrong. Okay, so that's some of the sort of interesting complexities about the composite model line. Right. Let me see if I can get to the other questions or comments. William says that this is a fairly large divergence from Hurst's spectral approach. It is, William, and for those of you who aren't familiar, there are two approaches to analyzing using Hurst cycles. The one approach is what we called the spectral approach, which is a primarily mathematical approach. You're performing a spectral analysis. You're using combs and very sort of mathematical techniques to extract the cycle information. And Hurst's book, The Profit Magic of Stock Transaction Timing, really presents the spectral approach. I think I'm correct in saying, and that book focuses on the spectral approach, and many analysts today still focus on that approach and take that approach. The other approach is to take the approach that Hurst presented in the Hurst Cycles course. Or I shouldn't say it's a completely different approach, because there are aspects of both of these approaches in the various ways of analyzing using Hurst cycles. But in my opinion, the Hurst Cycles course presented more of a a pattern recognition, identifying the troughs and peaks in the cycles, not using purely mathematical processes, but using the sort of human logical thought process, if you can put it that way. So you have a look at the troughs and you find those prominent ones, and you use your human intelligence to sort of process the logic in performing the analysis. I am very much an analyst that takes the latter approach, the visual approach. I often speak about Hurst cycles analysis as being more of an art than a science. That's just because that's what works for me, and both are very valid and very useful approaches. I tend to take more of the visual approach, so you should be aware that I'm that kind of an analyst, and these webinars tend to focus on that approach because that's just what I do. But the spectral approach is another approach, and an equally valid, perhaps even more valid approach to performing Hurst cycles analysis. So that sort of expands on that a little bit. And David is asking William to publish results. I hope he will soon on the Hurst cycles website. Greg, when is the next version of Sentient Trader going to be ready? Greg, it's very nearly ready. It's been very nearly ready for a long time. It has been delayed because of the trading platform plugins, which were being developed independently. But we reached a point in the development of Sentient Trader where we had to make a decision. Do we release the new version of Sentient Trader and then get the trading platform plugins to catch up with it and then put them together again, or do we delay the release of the new version of Sentient Trader? So we made that decision, whether rightly or wrongly, I'm still not sure, but we made that decision. So it has been delayed because of the trading platform plugin, unfortunately. I think once both the new version of Sentient Trader and the trading platform plugin are ready and released together, I think you're going to be grateful that we did wait, because it's a very powerful combination. That's an answer to that question. And right, Piotr says next trough of 180-year cycle is due in 2043. 180-year cycle. Wow. Okay, that is going to take some interesting analysis work. And as John says, the key to this analysis is how you treat the 2009 low. Very important point. And of course, as William says, the further you project into the future, the greater the error. Okay. Clive asks, will Sentient Trader work with Windows 10? Yes, it does. And as Claudia says, it does already work with Windows 10. I've been working with Windows 10 on most of my computers for a long time using Sentient Trader and working with 64-bit Windows 10, as I am. So, and there are no problems. Windows make it very difficult for us to test new operating systems before we release them. So sometimes we do have to play catch up, as we've had to recently for DT and IQ feed data. But we do usually get there. Okay, let me now, we're already running long, but let me now get to what I promised I would be speaking about in this week's webinar, which is a consideration of what's going to be happening in the short term. And in this discussion, I'm going to be able to explain a little bit about my approach to Hurst cycles and how I use them and how I use Hurst cycles to trade. Because it's all very well looking at interesting analyses, something I love doing. At the end of the day, you have to, of course, make some trading decisions, and really where the rubber meets the tar, as they say, that's where it all needs to start making sense. So I'd like to start doing that. The first thing I'd like to say is this is a chart with the S&P 500, and it only has data going back to 2000, as you can see. We've just been looking at data going back to 1950, and in last week's webinar, or our last webinar, we looked at data going back to 1897. Lots of data is very useful for analyzing and understanding the bigger picture. But when you're going to make trading decisions, or let me qualify that, when I'm going to make trading decisions, and I'm not speaking about intraday trading decisions here, if we get time, I might today just dip into a little bit of discussion about intraday, and I'm going to show you how I apply the same techniques that I'm going to discuss here to intraday trading. But when I'm making trading decisions, I believe it's important to focus on a time frame. So for me, my time frame is I'm looking at trades that I'm going to get into and hold for perhaps a week's. I trade lots of different time frames, but today I'm going to speak about entering a trade that you'd hold on to for a week or two, perhaps. So for me, I don't need an data going back to 1897 in order to make a trading decision for a trade that's going to last a week or so. And I think that's a fairly important point. Sometimes I know people get a little worried about how much data they have, and do they have enough data to make trading decisions. So here you can see a chart going back to 2008, and that's enough data as far as I'm concerned. In our last webinar, I presented two possibilities for the S&P 500, and I'm going to look at both of them here and talk about how, even when there is some analysis uncertainty, one of the wonderful things about Hurst cycles is that you can still make trades with some confidence, because your trading decisions are often the same, even if there are different possible analysis outcomes. So one of the possible analysis outcomes is what you can see here. And my pen, for some reason, doesn't seem to want to work with Click Webinar. So this is the possibility, and I'm touching on it for several weeks, if not months. The one possibility is that the 18-month cycle trough was expected about now, and that therefore price is bouncing out of the 18-month cycle trough. That's the one possibility. Let's quickly change that and show you the other possibility, and then hopefully I can come to sort of pull it together. Here is the other possibility. This possibility suggests that price formed an 18-month cycle trough in August of last, and that the trough that it is busy bouncing out of now is the 20-week cycle trough, as you can see from this nest of lows. So those are the two most likely possibilities, in my opinion. And many people, when they're presented with two possible analyses or alternative analyses, get cold shivers down their spine, and they think, this is too much for me. There are two possible things that are happening. I need to make concrete trading decisions, and yet there is uncertainty here. Well, in my experience and my approach to trading, you have to make concrete decisions, but you have to make them despite the fact that you have some uncertainty. So the important thing to do is to work out what you can be certain about. And for some time now, I've been expecting this trough to be a trough of either 20-week magnitude or 18-month magnitude. My preferred analysis was for a long time this you see here, that price was going to come down and form a 20-week cycle trough, and then it would bounce out of that 20-week cycle trough. Okay. As you can see, price has bounced out of that trough. It came down and formed a double bottom. As you can see, it formed a possible 20-week cycle trough. Where was that? Sometime in January. And then on the 11th of February, perhaps I should zoom in instead of drawing tiny little circles. There we go. Then let me just switch. While freezing that chart, I switched images. There we go. Okay, so it formed a trough again on the 11th of February. The first thing I'd like to mention here is that some people, when they start working with Sentient Trader, become very enamored of these diamonds. They really like these diamonds because they're such a lovely visual symbol of a trough that has formed in the market. And these sort of sometimes rather messy circles and whiskers over here, which present expected time for a particular trough, they often look a bit messy and they're a little unresolved. And so they really want Sentient Trader to turn those what are called nests of lows into nice stacks of diamonds, because that gives them some confidence. And I believe it's important to not worry about that. The important thing is not when Sentient Trader turns a trough into a stack of diamonds or a peak into a stack of triangles. The important thing is that the nests of lows tell us when to expect a turn in the market. And that's really what it's all about, is having good reason to expect a particular turn at a particular time. Because if you know that that's what you are expecting to happen, you can make trading decisions on the basis of it. It's very important not to wait until Sentient Trader converts the nest of lows into a neat stack of diamonds, because by the time it does that, it's usually too late to enter your trade. Okay, it's a really important thing. So don't get too hung up on whether there are diamonds or whether there are circles and whiskers. The important thing is the circles and whiskers tell us when to expect a turn in the markets. So let's just zoom in here and start with the 20-week trough, and I'll show you what I do. Here we have a nest of lows. I've probably zoomed that in just a little too much. Here we have a nest of lows indicating that we were expecting the 20-week cycle trough round about this time for this nest of lows. Okay, because we were expecting the turn there, we got a first turn over here, which was turned out to be a false move, of course. We finally got the formation of the 20-week cycle trough at that point there. I can say that with the benefit of hindsight. I can say, oh, well, that was the 20-week cycle trough. Of course, at the time, it's very difficult to know at what point you can actually identify that that is definitely the trough that you have been expecting. So how do you make trading decisions? Well, there are many ways of making trade decisions on the basis of this cycles analysis. I'm just going to present one of them, which is, of course, my favorite FLD. In this case, the 20-day FLD, and the 20-day FLD. The FLD is the future line of demarcation. I'm not going to dwell on it now. We've got about 5 minutes left before I should start trying to wrap this webinar up. But it's the future line of demarcation. It's a very simple line. It is median price displaced right. The amount that it is displaced is very important. It's based on the cycle analysis, and so you can mess it up quite bad by displacing your FLD number of bars. But the FLD trading strategy is a strategy that is based on a very reliable way in which price interacts with that FLD. And I'm just going to show you the basics here. Starting from a trough of at least 80-day magnitude, over here, the first interaction you should get is a nice clean cross up above the FLD. I label that an A category interaction. And you then expect price to achieve a target which is calculated by measuring the distance from the low point to the actual price crossing point and an equal distance upwards, and you get your target for the move. Then price generally comes back on towards the FLD. Sometimes it touches it, sometimes it doesn't quite touch it, sometimes it drops below it. But our general expectation at this point, and this is the B category interaction, is that price will find support at the level of the FLD. Then it will bounce up again, C category interaction. Now that's all past history, and we can look at it in a little more detail in a moment. But I said I would speak about what I expect to happen over the next few weeks. Well, this is what I expect to happen. I expect price to come down below the FLD in what we will label a D category interaction. That provides us with a short trading opportunity, and it will happen as price comes down into the 40-day cycle trough, which, as you can see, is expected over here. Here's the nest of lows. It's expected towards the end of next week. So sometime between now and the end of next week, I expect a short trading opportunity. I further expect that price should achieve a target as calculated by projecting the distance from the high to the crossing point of the FLD downwards. I expect it to achieve that target fairly accurately. However, we've just taken a look at some very interesting charts that Sid has shared with us, indicating that the market is very possibly entering into a major bearish phase. If the longer term cycles are turning bearish, then our short trading opportunities are probably going to prove to be more profitable, and there's a good chance that that target to the short side could be exceeded. However, the important thing is that we make the decision to enter the trade. We enter the trade, and then we just watch it, and we see where that, where that 40-day cycle trough occurs. The 40-day cycle trough is expected sometime, as I mentioned, towards the end of next week, after which price is expected to bounce up again, and it will give us a long trading opportunity when price crosses up above the FLD. Of course, we can't see that FLD yet because it hasn't, the price to generate the FLD hasn't happened yet. So we will get an E category long trading opportunity. We will then get a second peak to our cycle. And again, whether that is a higher peak or a lower peak depends on the state of longer cycles. So bear in mind that we might well be moving into a seriously bearish phase, in which case it might be a much lower peak. However, if this is an 18-month cycle trough the price is out of, then we would expect a good deal of bullishness from our our 40-week and 18-month cycles. So it could be that that bullishness is enough to take us up to a higher turning point over here. At that point, of course, price will turn down again, and it will come all the way down into the 80-day cycle trough, which, as you can see, is expected towards the end of April, beginning of May. That will give us an F category trading opportunity. So according to this analysis, I have 3 trading opportunities that I'm already able to identify. I cannot yet identify the exact levels, but I can identify the fact that there are 3 trading opportunities that we're going looking at over the next 6 weeks or so. The first is a short trading opportunity as price comes down into the 40-day cycle trough. Then we'll get a long trading opportunity as price bounces out of the 40-day cycle trough. And finally, another short trading opportunity as price drops down into the 80-day cycle trough towards the end of April. Now, I haven't yet made trading decisions, but I have identified the trading opportunities that the markets should present us with. And as the markets play out, I can refine my consideration of those trading opportunities and make very hard, concrete trading decisions on the basis of the level of the FLD, because I'm using the FLD trading strategy. Of course, you might use another trading strategy and just use your Hurst analysis to help you to identify the direction of the markets. But now, how would the direction of the markets be different if this turns out not to be the correct analysis? Well, before we leave this chart, let me just show you. This is the rough M shape that I would expect, assuming that this is a trough of the 20-week cycle as shown on this analysis. You can see it is a slightly bullish shaped M cycle. M-shaped cycle. Okay, all cycles draw M shapes on our charts. Slightly bullish M shape. Why? Well, because this is a trough of the 20-week cycle. Now, the other analysis that I've already presented to you, which is a possible alternate, is this analysis over here. And if I zoom in on roughly the same sort of time period over here, you just slide that a little bit to the left. There we go. How would my trading differ if this turned out to be a trough of the 18-month cycle. Again, let me just quickly draw this FLD on here. There's our 20-day FLD. Here you can say price crossing of the FLD, the A category trade, and then price came down to the FLD, found support at the FLD. That's the B category interaction with the FLD. It's not a trade usually. And there's the C category interaction as price bounces up. The D category interaction is when price comes down below the FLD. So again, we have a short trading opportunity as price comes down into the 40-day cycle trough. Do you notice how in this particular analysis, those nests of lows at the foot of the chart are much more messy? Okay, and that's really because the software has not yet determined the position of this 18-month cycle trough. So you get very messy nests of lows. So it does make the trading opportunity identification process slightly more complicated because you're dealing with messy nests of lows. But nevertheless, we have the same trading opportunities, a short D category trading opportunity as price comes down into the 40-day cycle trough. Then we'll have an E category long trading opportunity as it bounces out of the 40-day cycle trough, and then finally an F category short trading opportunity if as price comes down into the 80-day cycle trough. Now there's the nest of lows. It's a very staggered nest of lows for the 80-day cycle trough, but by the time we get to April, those nests of lows will be much more refined, and we will have a much better idea of what to expect. So as you can see, we have the same three trading opportunities looking ahead for a period of about 6 weeks. You know, we have the same trades. The exact levels might differ slightly, but probably not very much. What is the big difference if this turns out to be a trough of the 18-month cycle instead of the 20-week cycle? Well, the big difference is that we have 2 more cycles that are pushing up, and so therefore the M cycle that we get is likely to be a more bullish shaped cycle. Okay, that is the only difference really. We have the same trading opportunities. Of course, our trading opportunities under this possible analysis are probably going to be less profitable, but they should still be profitable trading opportunities. So that is how I identify trading opportunities using the FLD trading strategy. And we spent a lot of time speaking about analysis, and I've had a lot of requests to, you know, sort of speak a bit more about trading in this webinar. And so I hope that this gives you an idea of how I use Hurst cycles. There are many different approaches, but this is how I use Hurst cycles to identify my trading opportunities. Before I sort of close off this discussion, I'd like to show you one other thing, and let's just go back to this chart over here. Let's zoom in a little bit and show you. There we go. If I highlight that FLD, although I probably won't be able to with the pen. Yes, there we go. Here is the FLD. So how do I actually move from identifying a trading I've just identified 3 trading opportunities which we're going to be facing over the next 6 weeks. How do you turn that from a trading opportunity into a trading decision? Well, what I do is I look at the level of the FLD, and I try to identify, of course, the magnitude of the troughs and so on, and the next interaction between price and the FLD is going to be. And so here is an example. There is the category interaction. So the entry would have been at the point at which price crossed the FLD, which is over there, and you can calculate your target. So in fact, let's just take a quick do this, and then I'll show you the easiest way of doing it, which is having the Hurst Signal Service do it for you, so you don't have to do all the thinking for yourself. If I measure the level of the FLD, and in fact what we need to do, there's a subtlety here, but let me just take a moment to show you the subtlety. The level at which price actually crosses the FLD is is the level at which the median line crosses that FLD. I see a question or two there. I'll get to this in a moment. Let me just finish this train of thought. So the level at which the median price crosses that FLD is considered to be the level of the FLD cross. And so if I put my mouse over there, I can read that level. It is 1886.5. 1886.5. There we go. And let's just change back to this, and let's measure this low point here. That low point was 1802.5. Okay, and so we have a total of what is that? 1802.5 to 1886.5. We have a total of 84. 84. What are those points? 84 points. Or 84 points from the low to the FLD cross. A typical A category interaction, if it turns out to be a true A category interaction, will move a further 84 points upwards, which gives us a target of 84 points above 1886.5 is 1970.5, if my maths is correct. 1970.5 is over there. So that is our exact target for that move upwards. And as I think you can see, price came to within a few ticks of actually reaching that target. And that's the power of using the FLD, because once you're in that trade, you're able to actually calculate the target. While I was looking at what I would speak about in today's webinar, I thought I might quickly show you this outlook over the next few weeks and what we're expecting over the next few weeks. I'd like to show you the Hurst Signals system, which is a system which identifies trading opportunities. And let me show you. Here is, you should be seeing a screenshot I've taken from an email that was delivered to me on the 15th of February. And here is an important point. Oh, I've drawn all over it, so it doesn't really help. First of all, according to the analysis, the system is telling us that the next price and FLD interaction is expected to be category G. However, it says in brackets, consider an early A category. And later on, when we're looking at the trading opportunities, you can see the system says there's no long G category trade recommend because we don't take G category trades. However, you should consider an A category long trade. Okay, and there's the A category long trade. And you can see it tells us it's a long entry at a level of 1889, which is the median price of the 5th of February. There's our stop loss, 1802.50. And here are our two targets. I won't dwell on them for now, but the main target is 1977. So back to my desktop, that target was projecting up to 1977, which was, of course, reached just a few days later. That was on the 1st of March. That target was actually reached. But you would have adjusted your target according to the actual level at which price crossed that FLD. So you probably would have brought that target downwards a little bit. We requests about, you know, how can we simplify the process of trading instead of just speaking about analysis all the time. I love speaking about analysis. I'm a real sort of analyst. But of course, I also enjoy trading. So our Hurst Signal system identifies these trading opportunities. I thought I would quickly pop in a little special offer to you for watching this webinar or for being here with us. Let me see if I can find it. There we go. If you're interested in having Hurst Signals help you to identify trading opportunities, then I can offer it to you at half price for a month of Hurst Signals. There you go. 3 instruments usually costs $39 for a month. 8 instruments costs $79 for a month. But if you use those links that are shown there on your screens, you'll get a month at half price, so that you can try them out. Hurst signals are a great way, particularly if you're learning about Hurst cycles. They're a great way of getting into learning how you could trade with them. It's just one of the methods. Of course, there are methods. So let me see a few other questions there. Najmuddin, if you apply a low pass filter, the Feb 11 low will appear more prominent. Okay, so a low pass filter is again part of the sort of spectral approach, and so that's a very interesting point, that it makes the February 11 low that much more prominent. Tycho has asked whether I can show the composites. Let me do that. Let me show the composite model line. I don't even know if I've built a composite model line for this particular analysis. Let me see. Composite model line. Okay, looks like I have. And let me show it. Okay, let me include some of the shorter cycles. And let me zoom all the way out. There's our composite model line. Okay, according to this analysis, that's our composite model line. But there's a very, very important disclaimer I must make in showing this composite model line, Tycho, and that is that this analysis only includes cycles up to 19 months or 18 months, the 18-month cycle. So it's only using those cycles to produce its composite model line. Okay, that's a really important point. The longer cycles are almost certainly all pointing down. So those longer cycles, very powerful cycles, are going to pull this entire shape downwards. Okay, that really is a very important point. But this is how I use the composite model line. I don't worry too much about fixed levels, but this composite model line is telling me that the drop down into the 40-day cycle trough is likely to be a bit of a miserable affair. Perhaps not worth taking a short trade there. But then we're going to get a good long trading opportunity bouncing out of the 40-day cycle trough. And then my third trading opportunity with the move down into the 80-day cycle is that one over there. By far the best short trading opportunity, however, is going to be for the drop down into July. But of course, there we're looking really quite far in advance. Okay. And Sergio says, what if the 18-month low has not occurred yet? Yes, absolutely. It's very possible that the 18-month cycle trough has not occurred yet, in which case that is the analysis I'm showing here, which has that, keep switching with us, which shows us that the trough in February is only of 20-week magnitude. It is definitely of at least 20-week magnitude, in my opinion. John, the Russell Index and the Nasdaq made low in February. SPX and industrials made its low in January with the transports. My guess is that this January-February trough was a higher degree, at least 20-week cycle, but watching the NYSE market internals, if it exceeds the 500 level, then Jan-Feb low was at least 20-week, if not 18-month cycle. So I hope you're all getting an idea, particularly if you're new to Hurst cycles, as to how one approaches the concept of the different magnitudes of the cycle troughs. It's often not possible to be 100% confident in the magnitude of a trough, but nevertheless you can make profitable or confident trading decisions, I should say. Of the further bullishness this year would raise questions about longer term cycles. Absolutely. Louis saying goodbye, Tycho saying thanks, William saying good work. Thank you very much, everybody. Thank you so much for joining me. Unless there are any other questions that I can answer, it is time for me to start wrapping up today's webinar. Thank you so much for joining me. Thank you for your interest in Hurst cycles. I do appreciate it. Thank you again to Sid for joining me on today's webinar. And I look forward to seeing you all on our next webinar, which will be in 2 weeks' time on the 21st of March. So I look forward to seeing you all there. If you'd like to take advantage of our special offer, signals at half price, then please do that.